What's going on, guys? Welcome to the Geeky Investor, where stocks talk and we translate. Today, we're going to be discussing about a stock that could potentially be a generational buying opportunity for all the investors that are watching this video right now. Adobe stock specifically has lost a lot in the past 5 years, although the company is really doing well. It could be something that is similar to Meta stock a couple of years ago, so make sure you smash this like button because it really helps grow the channel larger, and stick till the end of the video because I'm going to be discussing why this stock could potentially be a generational buying opportunity in my own opinion. So first of all, let's quickly look at the share price right here. So over the past 5 years, we can see that the stock is down by almost 38%. And if we just look at the past year alone, it was down by almost 38%. However, if we look at the PE ratio, it's now sitting at around 16.2, which is kind of really interesting for a company that is growing really fast. So let's start with the graphs that I'm showing right here. So I'm going to put a full screen right here. So beginning with this interesting place right here. So as you can see right here on the PE ratio and on the price to sales ratio, which are those ratios that would tell you that the stock is kind of undervalued or overvalued in a simplified manner. So if we look at the PE ratio in 2021, it was around 60, and now as we can see over time, the PE ratio has been trending down and reached almost 16 as of the time of this video. And if we go to the price to sales ratio, it's down from almost 18 to now almost 4 or 5 price to sales ratio. So what is really happening to the stock right here? So the stock price is kind of going down, although the financials of the company, as we're going to be seeing in just a moment, are kind of going up. Now, we all know that the average price to earnings ratio of the S&P 500 over the last couple of years, at least over the past 5 to 10 years, has been around 20 to 22. All right. So the mean and the median for S&P 500 and Nasdaq are around between 15 to 20 or 22. And as we can see right here, Adobe is at or even below the price to earnings ratio of this kind of Nasdaq or the S&P 500. And as for the price to sales ratio, that's a different story. So first of all, let's see. So management has taken advantage of the lower prices, and as we can see right here, the lower the prices, so if we zoom in, we can see that the prices were kind of low in 2023 and then back again low 2025 and then 2026 as we're recording the video right here. So if we look at the repurchases that the management has done, as you can see, the lower the share price, kind of the higher the stock repurchases that the company and the management are making. Especially if we look at 2025, it was the largest at around 11 billion US dollars. But if we look at 2023, when the price kind of peaked in 2023, as you can see, the management has decreased what they were buying as it was compared to 2022. So this gives you a signal that the management is really understanding their company and they know when their share price is kind of undervalued. And as we can see, in 2022 they were buying heavy, in 2023 they decreased, and then back again up, they were buying heavily on and repurchasing heavily of their stock. So the board has approved a new 25 billion repurchase authorization till 2028. So basically within the next 3 years, we're going to be seeing the management to kind of repurchase around 25 billion US dollars of their shares. Now, if we go to Adobe's financials on stockanalysis.com, and as we can see on the balance sheet and the cash and cash equivalents, they have $5.4 billion as of the end of 2025, so $5.4 billion. But if we look at the cash and short-term investments, around $6.5 billion. But then if we go to the cash flow, and as we can see on the operating cash flow, they have $3.1 billion. Now, this purchase of 25 billion share repurchase authorization, this is over the next 3 years. So they are really able to do that from the financial perspective. All right. So if we move on to the graphs right here, and this is a really interesting slide that I want you to focus on because this will help you build your thesis on the stock and on the company. If this is an interesting company and kind of there is a mismatch between the financials of the company and the stock price by itself. So if we look at the right side, I'm going to be zooming right here. So if we see, this is the total revenue for Adobe on the right side. So this is from 2021 all the way into 2025. And as you can see, the revenue has been increasing in a very nice, consistent manner by around 10 to 15% on an annual basis. So it was in 2021 around 15 billion total, $15 billion, and then now it reached $23 billion. So that's a nice increase over the past 4 to 5 years in a very consistent and nice manner. If we can see, the gross profit has also been consistently going up, but if we see the earnings per share has kind of increased even at a faster clip as compared to the revenue. And why this is happening? Well, the idea is because the management is kind of repurchasing their stock. So what is happening to the earnings, price to earnings ratio? So the earnings per share, basically because we have less shares, so the earnings per share kind of go up very quickly. And as we can see, right now with on stockanalysis.com, if we go to the income statement right here and we kind of zoom in on the earnings per share, and as you can see, it was up by 17%, 11%, 12%, 200%, and that is kind of, growing at a very nice clip. As you compare that to the revenue growth, it's around at a consistent of 10%, but the earnings per share is kind of growing at a faster clip. And the idea is, whenever we have a company's share price, the share price over the long term, as we all know from Warren Buffett and many other legendary investors, and from the stock market history by itself, the earnings per share the stock price always follows the earnings per share. And whenever the earnings per share are kind of going up, in the long term, the stock price should be going up. But as we can see, over the past 5 years, the stock was down by almost 38% as compared to this very nice growth in the earnings per share over the last 5 years. Now, that was on a quarterly basis. If we go back to the annual basis, as we can see, 35%, 4%, 17%. So it's kind of growing at a very nice clip, as we can see right here. So over the past 5 years, it increased from 10 to 16. That's an increase of almost 60 or 70%. All right. So an increase of 60 to 70% in the earnings per share, as compared to a decline of 38 or 39% in the share price. So what does this tell you right here? That there is a very big mismatch between the stock and the financial performance of the company. Well, let's see if the investors are really kind of, because we all know that investors are forward looking. Let's see if this stock is kind of, or this company is not able to maintain in the future the revenues that they are bringing, or the earnings per share that they are kind of able to obtain. So now, earnings per share has grown faster than revenue, largely due to a significant reduction in share count from buybacks, as we just talked about. And this situation kind of resembles Meta platform during 2021-2022, when strong fundamentals contrasted with a sharp stock price decline. So let's look at Meta's share price right here. So if you look at the past 5 years, so if you have invested in 2022, the stock has rewarded you with more than 5x the investment that you have put. That's a very, very nice reward within just 5 years. So 5 times multiplying your initial investment. Now, if we look at the share price right here. So in 2022, as you can see, the share price was almost as low as back in 2018, guys. So if you look at Meta, so now I'm going to be going to Meta platforms, which is Facebook basically. So in 2028, at that time, well, unfortunately, we're not able to go back by that time. However, what was happening is that the revenue of the company has been trending up, while the share price, as you can see, from 2018 all the way into 2022, the price was kind of flat if you look at it in this way. However, what happened, because there was a very large divergence between the share price and the earnings of the company, look at what happened: more than 5x or even 5 to 6x of their stock within a couple of years, and that's a phenomenal growth in their investment. Now, I would say that Adobe is kind of facing a similar potential right here, because the idea is, Meta, a couple of years ago, everybody was saying that Meta is doomed and nobody's gonna be using Facebook and these social platforms. However, what we all know, that the platform has been really growing in a very nice manner, and Metaverse did not really take the world in that sense. So If we look at Adobe's revenue performance over the graph right here, so total revenue growth in 2023, and then if you go up, so it's kind of up 10%, 10.5% over the last 3 years, reaching to $23 billion, and the geographic revenue distribution is very nice in this stock. So as we can see, Americas represent around 60%, while Europe, Middle East, and Africa all represent around 27%, and then Asia kind of representing 14%. So as we can see, that's a very nice distribution for such a company, because they are able to kind of, distribute their revenues to different countries, different parts, because if one country is kind of weak and experiencing a conflict like is happening in the Middle East right now, then this could potentially lead the company to be able to kind of manage their revenues from these different sources and different countries. Now, if we zoom in on the segment revenue trends and subscription depth, now here, as we all know, that the revenue for Adobe is kind of mostly driven by subscription penetration. As we can see, for digital media, they have two main segments from their revenue. It's kind of coming from digital media and digital experience. And before we dig into this graph, I'm going to be explaining what these actually do. So Adobe's digital media is what we all know. It is basically Adobe's Acrobat PDF reader, Photoshop, Illustrator, Premiere Pro, all of these apps that we all know and use on our daily basis, or at least we've seen some people kind of using them in their daily lives. So this is the digital media segment. However, they also have this other segment, which is mainly for enterprises and big companies. So this enterprise level solution for managing, measuring, and personalizing the customer journey across digital touchpoints, and it includes Adobe's Experience Cloud, which is really essential for these companies. So now that we have really understood what these two segments are, if we zoom in on the subscription penetration, it is almost 98% for digital media, which is Photoshop and Adobe Premiere, and the ones that we all face. So 98% of that is subscription based, and 92% of the digital experience, which is for enterprises, as we just said, is kind of made with subscription penetration, and that's a very nice number. Now we can see that the composition details right here. So digital media is kind of making the most and the biggest chunk of the revenue, which is from direct customers like you and I, and then from digital experience, that goes for enterprises, that's almost 1/4 of the revenues of the company. Now, if we look at the digital media, which is kind of in black right here, it's kind of trending up, and the same is happening to the digital experience platform. Now, publishing and advertising, that's a very old segment of Adobe, and they are kind of getting rid of that. So just forget about it. It's just $300 million in 2023, and now almost $200 million. That's nothing. They are making $23 billion. So as you can see right here, they are in a very nice position. So they have very nice, because of that subscription. If we look back to Adobe's financials and their profit margins, as you can see, their profit margin is really high. It's between 25 and 30% over the last couple of years, and the same is happening for their gross profits. All right, so that's a very nice thing that you can see. So their operating margin around 35%. And that is all because of their high profits coming from the subscription penetration. So the company benefits from a highly sticky business model, with digital media and digital experience generating around 99% of the total revenue. Now, are we seeing any signs of deceleration to the business that is kind of making this kind of making those Wall Street analysts kind of downgrade the stock and sell the stock? Well, of course, we're not seeing any deceleration to the revenue in terms of their revenues, in terms of their profits, in terms of their margins. So I don't know how those people are kind of making this up. There is a story that can be built that Adobe's stock or Adobe's business could be in a disaster if they are not able to keep up with the AI, because we know that ChatGPT and these other large language models are able to build a lot of videos and photos with a very nice editing power. So kind of Photoshop and these other programs might be obsolete if they are not able to keep up. So that's one of the main reasons that is kind of leading to the stock to be down, because, you know, what if they are not able to maintain that? However, we have seen that the management able to consistently lead to high performance over the last 5 years at least, and even more so over the last 10 to 15 years. And that really proves that the management is able to kind of go up and move on with all these different situations that they face that they have faced over the past 10 to 15 years. And much of this revenue is coming from subscription-based products, as we just said, and the stock has been pressured largely due to concerns that AI could disrupt the creative software industry. However, the company is already investing in AI, and we've seen a couple of examples that we're not gonna be discussing right here in today's video, because this is more on the news part. And then any meaningful disruption to the industry would likely lead to several years if that occurs at all. So maybe in the next 3 to 5 years, Adobe as a business is in a very nice situation, and I think that the stock will follow the earnings per share of the company over the next 5 years. So make sure you smash the like button, because it really helps grow the channel larger, and let me know in the comments down below if you think that Adobe stock is a buy or not.